Hey guys, we are here for our next session. It is a data-driven look at Bitcoin liquidity around the world with Wyre. We have Jack here. He's the head of partnerships at Wyre, and I'll let him take it from here.
Awesome. Hey guys, can you hear me all right here? Cool. I'm gonna just port this over to my slides. Awesome. I'll just get started then. Yeah, so hey guys, I'm Jack. I am head of partnerships at Wyre, and we have been in the crypto ecosystem since 2013, and definitely started by doing a lot of things just with Bitcoin. Recently, in the past 18 months, have moved into the Ethereum and stablecoin space, but Bitcoin is definitely dear to our hearts. Not sure if you guys know, but just going over some recent partnerships. Wyre has become a member of Blockstream, and we also added support for LBTC. So now you can go literally from your debit card to LBTC in one hop. Yeah, so that's a very close relationship that we have with different liquid teams as well as Lightning teams that hoping to do a lot of different things in the future. But yeah, I mean, just a quick intro about us. If you don't know who we are, we have this very easy on-ramp to basically go from your device, like your phone, Apple, Google, and Samsung, to Bitcoin or Lightning or Liquid. And that's something that we will be focusing on going forward, which is fiat on and off ramps, which you guys just got out of Catherine's session. Very, very similar to that. The only difference is we take our stack and we give it to other teams to use, as opposed to building out an exchange or brokerage ourselves. Just a little bit of history. We were founded in 2013, led by Tim Draper and Boost VC. We became an MSP early on. Initially with the crypto payments, because in the first bull run, if you remember, after Bitcoin broke $1,200, there was this huge kind of hype around merchant adoption. Obviously, in the early days, since we're talking about Bitcoin liquidity, the way that the Bitcoin network initially bootstrapped liquidity was through kind of merchant processing, right? So whether it's Silk Road, that was the original use case that helped Bitcoin to actually become resilient very early on, and then obviously Mt. Gox and all the different exchanges that were born afterwards. But crypto payments was always something that was very important, going from Bitcoin to fiat for different merchants, the BitPay types. In 2015, we realized that hey, not enough people have Bitcoin. How do we get this in the hands of different users? So we came out with this MassPay API and worked with the Microsoft to basically be able to send Bitcoin to people for using Bing. It's not a great browser, but as one of the rewards that you can claim for surfing on Bing, you can actually earn some Bitcoin. And yeah, in 2017, we kind of rebranded because we realized that with the Bitcoin to fiat off ramps for crypto payments and the kind of like the wallets going from fiat to crypto, you can actually combine the two to do cross-border payments using Bitcoin as a rail. And that's why we're called Wyre with a Y for wire transfers. And now today, we're a regulated kind of money transmitter across different jurisdictions. We either have our own money transmission licenses, or we work with different partners locally that are also registered with the local governments. And having this regulated on-ramp, we're able to basically offer this transfer API that aggregates liquidity across different exchanges and reputable OTC desks, basically using their RFQ-based API or different kind of Binance API or Coinbase API, aggregating all that liquidity across different regions to move money around the world much faster and cheaper, because it's a completely different rail, using Bitcoin in the middle as opposed to traditional FX such as Swift or other FX brokers. Yeah, so now we have this one API that you can do crypto to fiat or fiat on ramps, or the custodial wallets where you can trade and exchange and convert within the Wyre network. And we give this API or widget over to different teams that then they can build their own brokerage or wallets or different kind of localized services related to Bitcoin or crypto. Cool. Yeah. So I mean, just jumping right in, guys. I think when we look at Bitcoin and data-driven way of looking at Bitcoin, obviously it has always been the biggest, right? In the very early days, there was not really any other coins except for Bitcoin. So the Bitcoin community was the entire crypto community. So obviously we had 90% dominance. In 2017 with the ICOs and all that, obviously, there was this talks of the flippening between Ethereum and Bitcoin. And now I still think there's like interesting things happening in Ethereum for sure, whether it's stable coins, whether it's smart contracts. I'm hoping that one day all of that kind of gets ported over to either Lightning or Liquid. But anyways, that's a whole nother topic. I think just looking at Bitcoin dominance is still number one. And yeah, there's a lot of different kind of use cases that drive its dominance. Obviously, the fact that it became first has a lot to do with it. But in its kind of historical development over this past 10 years, it's taken over a lot of different market shares. For example, with OTC institutions, right, Bitcoin has become kind of this digital gold, and a lot of different institutions in Chicago or in New York, they are trading Bitcoin via OTC. Now, I think the volume there is a little bit exaggerated. There's this one study done in 2018 by, I think it was Tab Group or something, and they basically interviewed a bunch of different OTC brokers, and they estimated that there was $12 billion in OTC trades per day. That was grossly overestimated. There was a lot of kind of ghost deals at the time. Perhaps one person needed to sell 100 Bitcoins, and then they told 2 people, and then they told 10, and then suddenly it seemed like there was 100 deals selling 100 Bitcoins. That wasn't really the case. There was a lot of kind of these ghost whales. Not to say that there aren't real whales, but just kind of looking at 1.5 million BTC per day versus the actual kind of on-chain transaction value that was actually traded. So yeah, so when you think about Bitcoin liquidity from an OTC standpoint, it's very hard to estimate, obviously, because a lot of it is order matching, and different desks do hold a balance on their books, and they do try to net it off. And other ones in dark pools, like in China and Hong Kong, where there's some cross-border remittance involved. It's very hard to have any data on that. But not to kind of underestimate what Bitcoin can do in the OTC dark pools. But yeah. Another use case, like I mentioned, with what Wyre does has to do with cross-border payments, right? And this was originally a very proven use case from maybe 2013 to 2017, and the remittance networks using the remittance networks, if you will, in Southeast Asia was very strong, right? So whether it's CoinPip or Bloom in the Philippines, these are all very reputable teams that have migrant workers maybe working in Korea or Hong Kong, and then needed to send money back home to the Philippines or Indonesia, and these different teams offered a service where on the front end it looked like just a regular TransferWise service, but in fact Bitcoin was in the back kind of powering that. So this is definitely a really great use case for sure. But if you actually look at some of the let's use Bitso for example, right? Bitso is an exchange in Mexico, and their daily volume for the past 30 months or 30 days was between 100 to 200 Bitcoins, or $1 to $2 million. Well, if you look at the remittance data for payments going into Mexico, just like P2P remittance alone is about $30 billion a year. And that excludes, B2B cross-border payments between different factories and businesses that do payments from US to Mexico or anywhere around the world to Mexico. So, for $1 to $2 million or, 100 to 200 Bitcoins in trading volume to go through this very key part of the infrastructure for a Bitcoin remittance, which is this local exchange for on-ramp and off-ramp, it really doesn't compare. So that's not where most of the liquidity is, I would argue, as far as remittance or OTC. And even looking at like local Bitcoin or Paxful, but these type of P2P exchanges like Huobi or CoinCola or OKX, where they have the different, this P2P bulletin board where people use their own fiat payment method to buy or sell Bitcoin using some sort of centralized escrow system. The volume there is also like not super high, right? It's probably 5 to 10 mil globally per day. So that's not where the volume is either, right? Most of the volume actually happens in exchanges, right? So looking at this yellow line right here, it goes by the left y-axis, and then whether it's different merchant services or gambling or anything else, it goes with the right y-axis. So you can see literally it's 1 order of magnitude or 2 orders of magnitude more, right, in terms of comparing other kind of ways to use Bitcoin for as compared to the volume aggregated on, or the trading volume or execution happening on exchanges. So most of the action is still happening on exchanges. So just taking a step back, then how do we actually then think about Bitcoin liquidity, right? So it's you have different use cases. You have remittance, you have merchant processing, you have retail users buying, maybe through like a brokerage like Cash App, and all of that actually gets funneled ultimately to some sort of exchange, right? Because if you're a BitPay, you're not an exchange, and where are you actually selling the Bitcoin when you get it? Or if you're any kind of merchant processor and you're trying to help a merchant to accept Bitcoin as a form of payment, but ultimately hedge out of position and get out of the price volatility, where are you going to actually then sell that Bitcoin, right? If you're a miner, same idea. You might do some margin lending where you might borrow, collateralize your Bitcoin to borrow USD or local currency to pay for expenses. But ultimately, I would argue that most volume funnels back to exchanges from those other use cases. So looking at the exchanges, then we can define liquidity as traditional way of defining it, right? As far as like being able to buy and sell in a market without affecting the price, right? And then slippage basically being the expected price of a trade and the price at which the trade is actually executed, right? So top of order book versus any slippage thereafter when you actually execute. And looking at how that looks across different exchanges, you can see that this list of exchanges here might look very different than this right here. And even though this list has much higher trading volume per day, right? In terms of the actual trades that are executed at a spot price without moving the price, it's a completely different list, right? And there's been studies that's been done before on this, very reputable studies that take a look at this, and basically there's a lot of wash trading and fake volume, and it's a way of basically if you think about it as a restaurant, right? It's like the first day you open a restaurant, you might have all your friends come so that it looks like a very popular restaurant, but in fact there was actually only 1 or 2 customers. So there's a lot of that happening throughout the years. Probably relatively less so now, but in the Wild West in between 2013 and 2017, there was a lot of wash trading, and this is nothing new, and we know that about most crypto exchanges, except for the regulated ones or reputable ones. And even just looking deeper at the data, right? All the regulated exchanges, they show very similar behavior when it comes to execution. There's more people trading, and so more trades get executed at less slippage, between let's say 0 to 2%. And then other exchanges that kind of either do wash trading or algorithmically go recreate the order book through either internal market makers or higher market makers. Their order books look very different when you go and execute between 0 to 1 Bitcoins. Yeah, and then right here, as you see, the kind of algorithmic market making that's happening, it's abnormal to say the least. And same here, right? So when you think about liquidity as many traders or market makers that are actually have real orders, then as people execute, you should expect a lower slippage on those exchanges, right? As you start seeing more slippage, that's not healthy liquidity. So this study from Bitwise in 2018 kind of this is where I took that slide from actually. This is from this 105-page Bitwise study, but one of this graph is very interesting, right? So they took a look at all the reported trading volume, and then they went and kind of parsed it out, using those rules to parse out wash trading and fake market making. And they actually found that there's only about $500 million per day in trading volume compared to 11 billion in reported trading volume. And this actually makes sense, right? Because if you look at PayPal, for example, they trade about $600 million per day, and their market cap is about that of Bitcoin. So looking at this chart right here, the actual volume for Bitcoin trading per day versus PayPal, which is about 100, I think it's around $120 right now. 5 million shares, about $600 million per day in actual volume. And so this actually makes sense on what the real volume is on different exchanges for Bitcoin pairs. And same thing with futures, right? After 2017, obviously CME and CBOE, along with other kind of regulated futures markets like BAC or other unregulated ones, OKX or BitMEX, we see the futures volume being a lot more comparable to actual volume when you think of actual volume as around 600 million. And this is very abnormal for any market to have such a big spot market but such low futures volume. So I think actual volume for spot market on Bitcoin looks more like this, and this looks a lot more normal for any kind of traditional finance people there. Yeah, and that's for what it's worth. I wouldn't call that bad news. The news is news, right? Like if we have 10 years of growth now, and we're at a point where Bitcoin has infiltrated the minds and the hearts of the retail as well as Wall Street, and it's a good thing in a way for Wall Street to get involved. One is bottom up and one is top down. So overall, I think that's healthy. But one thing that's really healthy, I think, is if you compare the spot price versus the futures price, that there's not that much deviation after a certain amount of time. And this is very different. If I had to show you a chart like this from like 5 years ago, there might be persistent deviance across time between different exchanges, right? And all that arbitrage has been neutralized. There's not kimchi arbitrage anymore, I don't think, even though for capital restrictive countries, you still might see that. But I think, for example, between Chinese yuan and Bitcoin and US dollar and Bitcoin, versus $1 versus 7.05 Chinese yuan, the price is pretty much the same. So maybe a few years ago there was persistently an arbitrage because it was a capital restricted country, and the effective exchange rate locally in China was it was more about 2% premium, because that was just what the actual FX rate was in the gray market there. But now I think it's a healthier market, right? It's more efficient market now. So arbitrage is getting neutralized fairly quickly, whether it's regionally for triangular arbitrage or whether it's between futures and spot. And just thinking about where things are right now, this graph is a little bit old, so some of the companies on here might not be fully accurate, but just thinking about, once again, that triangular arbitrage, right, between different exchanges that are in different regions, right? The capital restrictive ones with Brazil and Korea and China, right? The kimchi arbitrage, that was 30%. I think all of those things, even though it's market inefficiency, it ultimately creates more liquidity, right? So liquidity creates liquidity, and that's the name of the game. So I think in the long run, it's good to kind of have those arbitrage opportunities, because then it'll drive up liquidity across different markets. And all the different use cases, once again, merchant processing and remittance being the proven ones, that helps to support a resilient network at large. Yeah, and this chart once again just shows that this is taken from 2019, I believe. Once again, this chart would look very different if it were just 5 years ago, right? As far as arbitrage across different exchanges and how fast it gets neutralized with the introduction of stablecoins in 2016 through Tether, and now all the different kind of ERC20 tokens, or I guess Tether's still on Omni to an extent, but yeah, I think with that, you don't have to go to an exchange, withdraw local currency, send a wire transfer to another exchange to capture the arbitrage. That'll just disappear, right? But with stable coins helping to literally make markets more efficient, it's made Bitcoin that much more efficient as a market. So Yeah, so basically, the conclusion here is, Bitcoin liquidity is significantly smaller than expected, but it's much more efficient than commonly understood. And yeah, with that, I think I wanted to take it somewhere else. So, we talked about Bitcoin, we talked about, the liquidity of Bitcoin and how resilient the market is. But how do we compare that to some traditional markets, right? If you think about each of these companies not as a company or a business, but thinking of it as a network, right? So, whether it's Didi or WeChat or Line or Kakao or Telegram, right? They somehow initially built a network between users, right? You can think of them as buyers and sellers. So, I think by taking a look at how these traditional teams have concentrated liquidity and built and bootstrap liquidity, we can take a lot of good takeaway lessons in how we can apply this to Bitcoin or crypto. So, my CEO, Michael Downworth, been with him since day one. I'm actually his first employee. It's been 6 years, and he always says, we're not trying to build a company, we're trying to see a network, because it's still very early days, and there's still billions of people that don't have any Bitcoin or crypto yet. How do you actually get it to them, right? And if they don't have a bank account locally, even if there's an exchange there, how do you actually allow them to interact with the blockchain or onboard? It's a one-way street. How do you see the network to the traditional legacy financial system so that everyone is now on this kind of very resilient crypto network or Bitcoin network, so that we can either do payments through Lightning or even run like a decentralized exchange on Liquid, right? And just be able to use Bitcoin all around. And that's obviously all of our goals here. So, using Uber for an example, without thinking of Uber as a company, but more as a network, they have buyers and sellers, right? And the buyers are the riders, the sellers are the drivers, right? And in the beginning, when they initially rolled out, they didn't roll out everywhere, right? They didn't say, okay, cool, we're going to launch Uber everywhere. They launched it in San Francisco to concentrate liquidity, right? It's the same thing with why Bitcoin initially was given over to dark web, because there was actual use case there. And so you had to start there to build a small resilient network at that time, right? So once again, thinking about everything as a network and how do you build a resilient network. And same thing with PayPal, right? They had a very kind of hacky growth plan initially, where literally they wrote scripts to ask different buyer or different businesses or merchants, like if they accepted PayPal as a form of payments, right? And kind of as head of partnership, that's very intriguing to think of it that way, where they're literally creating demand, and just through like a growth hack. But there's some takeaway lessons there, I think, right, with how they served as their own market maker, and try to create a two-sided market when there was none, right? Because everything with liquidity is about kind of the chicken and the egg. How do you actually solve this issue with bootstrapping a network? So what should we do, right? We should, in Uber's case, once again, you don't want to launch in 100 countries. You want to launch in one city, right? And that's geographically, but you can think of it differently too. It's like, well, there's different regions where Bitcoin is probably needed more than others, right? And once again, there's so many use cases. The institutions is a whole nother gambit, but I think from our perspective, it makes sense to think about bottom up, right? How do we reach end users? So you don't want to offer a ride that's 41 minutes away because you have very thin liquidity, right? That's the equivalent to slippage, right? So how do we concentrate liquidity and grow it over time, right? And then also proxy in liquidity, right? So, assuming that most liquidity is sitting within the within the legacy financial system, so most people are, they actually have money somewhere else, right? How do we proxy that in, right? So kind of like what Lyft did when they went into China and literally just brought a bunch of drivers from Didi into the Lyft app, right? It's the same idea. And then, from our perspective with Wyre, we think of it as, how do we reach end users who already have a bank account or Google Pay and Apple Pay, Samsung Pay? Is very simple, and go from their existing user experience on their phones to the Bitcoin blockchain in some way, shape, or form, right? And that's literally proxying liquidity once again from existing users in the traditional legacy financial system over to the Bitcoin blockchain. Yeah, sorry for rambling there, but that is the end of my presentation. And let me see, how do I switch back here? Toggle video. Sweet. Awesome. Cool, I have 5 minutes here, so I guess I will answer some questions. What are limits per year, per month? I have seen limits imposed on Dharma app that use Wyre. So limits depend on KYC tier. If we don't do any KYC where we, sorry, actually, I don't want to answer a question because that has nothing to do with Bitcoin. It has more to do with Wyre. Let's see. You can find more information about our limits at let's see, docs.singwire.com is probably best. But also I can give you guys a link here where you can check out more about Wyre. Or you can just follow me on Twitter or Telegram. That's my handle. Cool, yeah, so what kind of apps can Wyre integrate with, etc., e.g. DeFi protocol that trades derivatives or securities where the legal framework may be murky? Is that a supported use case? Yes, so think of it this way, right? So everything that's on-chain, that's happening from smart contracts and decentralized non-custodial wallets, that's not actually regulated, right? So FinCEN came out with a ruling, not a ruling, a guidance in May 2019, I believe it was, where they went through step-by-step who is regulated as a money transmitter and who isn't, right? So the too long didn't read version of that is, you know, if you as a user is performing some kind of action with your own non-custodial wallet and interacting with some kind of smart contract on chain, presently at least, none of that is regulated because technically another service provider such as Wyre did not take any custody of funds on behalf of that user. Because, you know, when you're sending money on the blockchain within those smart contracts, it's you doing that through your own wallet, right? All Wyre is doing is helping the user to go from, you know, the part where we're regulated for is doing the KYC AML in the traditional legacy financial system, right? Helping you to take money from your bank to your non-custodial wallet. And then at that point, whatever you do with your money is up to you, right? So yes, long story short, different DeFi apps are able to use Wyre to build out different protocols. And that's actually, you know, kind of what you see here. So, you know, for example, replace Bitcoin and Lightning with, replace Bitcoin and Lightning here with Maker, Compound, and Uniswap, right? And you'll be able to, yeah, use Wyre to go from fiat to different smart contracts. Who can get Bitcoin today? But there are many people who can get Bitcoin today, but don't. It's not like a traditional social network because Bitcoin is used more for its non-network contributing value than its network contributing value. Transaction between people and merchants. Yeah, that's true. I mean, there's a lot of hodlers. You know, we're talking about Bitcoin liquidity, which is mostly concentrated on exchanges. But if you even zoom out a little bit more, you'll see that most people are just kind of holding Bitcoin and not moving or not using the network, right? And that's part of their choice as well. I would argue that in the long run, you know, something like a liquid network or a Lightning network can help with those use cases, similarly to how Ethereum and ERC20 tokens are currently helping Ethereum. But yeah, I mean, that's, you know, for the future for us to see. Cool. I think I might be out of time, so I will stop myself. Last dance. Yeah, and if you guys want to follow me, I'm on social media here. You can see this. Demonopolize. Break up monopolies.
Awesome, cool. Thank you so much for the really great talk. We're going to transition to the next session now.
Sweet.
All right, thanks. Bye.